Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This week we speak with Ed Goldstein, CIO of Coller's credit platform. Ed, it's great to have you with us.
Thank you for having me, Randy.
So let's talk about credit secondaries, which is what you guys do. We wrote in our Lead Left publication a few months ago a lot about the equity secondaries market. And I got a question immediately, well, what about credit secondaries? And so we thought this would be a good thing to get the expert on and talking about it. So maybe give us a little sense of the history of credit secondaries development and maybe sort of Coller's role in all of this.
Sure. Yeah, happy to do that. So maybe I'll rewind history a little bit. I know we're going to talk about credit here, but if you think about secondaries as a market, it really started 30 some odd years ago as private equity started to come into its maturity. Jeremy Coller, founder of our firm, is considered one of the pioneers of the market, formerly a pension fund manager who saw an opportunity to provide liquidity to people who were looking to sell their positions in private equity funds. And so if you fast forward today, it's a $100 billion plus market, which
Wow.
back then people never would have forecasted. But if you look at where we are today, private credit in a way is 20 years behind private equity, meaning private credit as an industry was quite small before the global financial crisis. As we all know, it was mostly banks lending, maybe some mezzanine funds, some specialist funds. And so it takes time for a primary market to develop before you start to see a secondary market. And so if you look at credit secondaries as a derivative of primary credit, what you're looking at today is an addressable market where the underlying asset class, which, some of which will ultimately trade or need liquidity, depending upon whose definition you look at, is anywhere in between $1.7 and $3 trillion. And so it doesn't take much of that market to trade to create a secondary market.
Interesting. So as with private credit in general, which has gotten a lot of attention because of the returns, stability returns, and so forth, it's probably natural that the trading of that market has also got a lot of attention. Do you see this in the same way that primary market has taken off as an inflection point for your market?
So I'm not sure I'd use the word inflection point, but it's definitely at a stage where it's starting to show a level of consistency in transaction volume. It's starting to become a little bit more mature where the education process for sellers, for GPs is starting to take hold. And even the intermediaries who previously, maybe there was a piece of credit attached to a larger equity book where some of them are starting to focus specifically on the asset class. So you're beginning to see, post-GFC credit funds of a scale where they're starting to reach the end of their harvest periods, still lots of loans in the funds, where you're looking at year 7, 8, 9 of a fund, where LPs are starting to say, okay, well, I've made a pretty good return, but I need some capital back, so maybe I'll look to the secondary market to get some liquidity in not just my equity book, but maybe there's some opportunities to take some liquidity in my credit portfolio.
So just backing up, if you are a holder of credit right now or an investor as a credit fund matter, why would you want to sell? Like, what are some of the things that drives selling? I mean, the private credit market, obviously, it's a little different liquidity matter, but it's been it's a yielding asset with a maturity date. What does that decision-making involve for sellers?
Actually, there were several questions lumped in there. I'll try to address them all. But if you think about what historically has driven selling in the private equity market, a lot of the reasons are similar, meaning it's not just, oh, my fund is underperforming, I need to get out. It could be a regulatory issue. It could be liquidity. It could be stress. It could be just opportunistic selling. So the reason for selling it's pretty varied, and we're seeing a lot of the same drivers in credit. Now, what is different, as you mentioned, is they're yielding assets, right? They are shorter duration. However, a lot of these shorter duration assets are still held in fund structures. So you might have a fund that is heavily recycling for the first few years, maybe extending loans. And so while you might have some turnover within the fund itself, you still have a fund that's still holding meaningful assets, later in its life. And so you have to look at it more at the LP level or the fund level rather than just the underlying loan level. Maybe one more thing I would add here, because it sort of part of the question about why would anyone sell performing credit, right? It's worth par, right? Why would I ever take a discount? And the way I would look at that is, again, if you're holding a fund that's 5, 6, 7 years old, you may take a discount at the time of sale, but your overall performance is not really impacted. And also, just as with the private equity market, valuations are sticky, but they might not actually reflect the fair value of what's in the portfolio.
Mm.
So, a year ago, we were looking at the leveraged loan index in the high 80s. And if you were a manager that had your private credit book marked at 97, it's probably worth par. But for someone who wants to sell, they're looking at a liquid market that says, okay, the whole market is worth less because that's the relative value. So investors do see that, that can't just look at what's in their hands, but also what the market is telling them.
And where do LP interests trade, assuming it's a performing fund?
Yeah, so for performing funds, there's a range, but it wouldn't be unusual to see a well-performing fund trade into the 90s, potentially a little bit below that. If you look at, older funds that might have some loans that are maybe a bit beaten up or distressed funds, that pricing tends to drift a bit lower, potentially in the 80s, maybe even a bit lower, really depending upon, what's in the book.
And for you, are you representing mostly sellers or buyers, or is it a mix?
So we are, we're a buy and hold investor. It's interesting, and this applies to all secondaries firms, not just credit secondaries. We're a GPN and LP, right?
Mm.
So, we buy to hold into liquidation, but we also, when we look to raise money from LPs, they're also, they're looking at us as the source of potentially good investment opportunity. So we often, we're on both sides of the aisle, and we need to manage that pretty carefully. But we have a pretty good perspective of how buyers and sellers think, given that some sellers are actually our investors.
And gives a sense of scale for your business, in terms of number of funds and.
Sure. Just going back a little bit in history, so we started as a single fund, right? We invested everything through a flagship fund, which was mostly equity, but we did some credit. And the fund as a whole is, we manage just shy of $30 billion today. The credit platform itself, although we've been investing in credit for over a decade, on a standalone basis is a bit younger. It was, formed sort of in the mid-teens. And so, that platform today, it manages a little over $3 billion, and obviously we feel like we're positioned for, to follow the growth of the market.
Mm. And in terms of the breakdown of the secondaries market, is it like the primary market for private credit, which houses in quite a number of different strategies, right? When people say private credit, they don't realize, it's a $1.5 trillion market, but, it's not all direct lending. You have venture debt, you've got distressed debt, you've got junior capital. How does it break down in your market?
So it's interesting. There aren't many players, for one. So again, it's a bit of a younger market. It's one of the reasons why we see so much opportunity is there isn't much dry powder raised yet, and so the way that we approach the market is capital perspective is if you're focused on senior, and we have, funds dedicated to that, it's a lower cost of capital, a lower risk proposition. And there are others in the market who are similarly focused. Beside that, as you look at other, subclasses, which include, as I mentioned, distressed debt or even things like structured credit, there are, some funds that are super narrowly focused on deep distress. There are others that may be focused on, more junior / opportunistic. But because there aren't that many funds yet, there's not a ton of stratification in the market. I would expect, in the future, you might see more and more specialization. But right now, I would say senior is sort of the most common strategy that people are looking at, in particular because from a cost of capital standpoint, you've got a good shot at matching sort of, bids and offers between, seller and buyer. And then the others are a bit of a mix of all those strategies and typically target higher returns.
I know that NAV lending is another specialty that's getting a lot of attention these days. How do you guys think about it?
Yeah, so we think of it as it's part of the, I don't know if the continuum is the right word, but it is a market we participate in because if you think about it, it is credit, right? And we're credit people, at least the platform that I manage is, but we're underwriting pools of cash flows, right? What secondaries are is whatever the assets are, you're underwriting pools of cash flows, generally very, very diversified. But if you're providing NAV loan or preferred instrument, you are for whatever particular reason, rather than buying them, you're financing them, right? You're taking them as collateral. So why might we want to do a NAV loan? So, for example, let's say you are looking at a growth equity strategy, which is looking to provide either some distributions or follow-on capital. And maybe 5 years ago, they would have gone to the secondary market and said, well, we'll do a strip sale, or we'll do a partial continuation vehicle. Sometimes it's hard to value assets if they're not sort of plain vanilla buyout. And so in particular, if you look back at really when the market started turning down, in 22 and even more recently, valuing growth and venture it's just harder, right? So can you come up with a product that provides that liquidity, that follow-on capital, where you're not necessarily crystallizing a valuation, but you're providing a form of liquidity where we as a lender gets sufficient coverage and protection and a sufficient return, but the fund also achieves its objectives of getting some liquidity and potentially having capital for portfolio companies.
So I know from our series on equity secondaries that in that case it's both a GP-led and LP-led market. There are reasons for both the GPs and LPs to want to buy or sell, different strategies to different rationales. What's it like in credit secondaries?
So today, I would say credit secondaries is more of an LP market. And part of that has to do with the maturity of the market. The other part has to do with the fact that, obviously, maybe stating the obvious, there's just not really upside in credit, right? So if you think of, the phenomenon, and I'll call it a phenomenon, but it's probably here to stay, single asset GP-leds in equity, right? You're investing for upside wherever those are priced to deliver, 2x plus. There's no such thing, and there will never be a single asset GP-led in credit, right? The risk is ridiculous. So for a GP-led to be successful or to be workable for someone like us or some of our peers, is you do need that diversified portfolio. And so the GP-leds in credit on the senior end will need to be portfolios that are still reasonably well diversified, or potentially combining multiple funds to create a diversified pool. At the more junior end, if you're looking at GP-leds for junior funds, distressed funds, those potentially can be more concentrated, maybe a bit riskier transactions, and so we'll see some of those as well. But right now, it's predominantly an LP-led market. And one thing I might mention that's also a little bit different in credit is private credit, because it's a newer asset class, has grown up with a lot of funds being raised through SMA structures or separately managed accounts or strategic partnerships. So you do have quite the proliferation of these vehicles that, if an investor wants liquidity, it's not really an LP-led because it's a single LP, and it's not really a GP-led because it's not a fund restructuring. So there's sort of this gray area where we have seen and we'll continue to see some of these SMAs or strategic partnerships that potentially become either available for secondary purchases, or where an investor may look for whatever reason to unwind or get liquidity. So I think we'll see those types of transactions in the market as well.
Interesting. So just wrap up with the perspective from the investor, right? What's in it for investors from a credit secondaries perspective? How does the credit side of the shop compare with what they would be looking at with equities?
Yeah, so it's not really a competing product. So if you're interested in secondaries and private equity secondaries, and you're looking for those types of returns, which is a multiple and IR based return, and typically you're shooting for kind of high teens. For credit secondaries, and I'm talking mainly for private credit, senior private credit. If you want those types of returns, you're not looking at private credit secondaries. It's more of an adjacency for someone who likes the private credit asset class, and maybe they are just starting a program and say, hey, I really love Churchill and I love these other managers, but I want to build a portfolio quickly.
Mm-hmm.
So I can potentially come into the secondaries market, invest in a fund, and get broad vintage exposure, manager exposure, quickly to help sort of round out my portfolio as I'm growing it, or as a way to manage volatility, to say, okay, well, I have my few favorite managers, and I know they're always going to do well. But if I can buy into a secondaries fund that, in addition to my top manager, which I know are going to deliver really well, I can buy into a fund that's going to have hundreds, maybe a couple thousand positions, and just really protect my downside by, rounding out my private credit into something that has, massive diversification and super low volatility. So we view it as sort of an adjacency to direct lending, but also an alternative to, liquid, semi-liquid fixed income. So people generally look at it with their fixed income hat as opposed to the hat that they're wearing where they're looking maybe at private equity secondaries.
Interesting. Ed Goldstein, CIO of Coller's credit platform, talking about credit secondaries and the credit secondaries market. Ed, we appreciate you joining us on Private Capital Call.
And I appreciate you having me. Thanks again.
So check out our other Private Capital Call interviews wherever you get your podcasts, and also check out our flagship weekly newsletter, The Lead Left, at theleadleft.com. Thanks for joining.